Markus. As I said, Markus is our first speaker. He will have a presentation. He will talk about the European property investment trends and all the challenges that we're looking into for the year 2024. And of course, we're going to take questions from the audience as always in these webinars. So please feel free to type in your questions or comments or whatever in the sections below, and I'll make sure to formulate all the questions to Markus at the end of his presentation. And after Markus's speech, we will go on with the panel with investors, developers, and bankers from all over Central and Eastern Europe to elaborate further on the investment trends for this years. As I said, welcome everyone, those who are now joining our first webinar this year at the Property Forum. We will have two webinars, this one and the next one next week, focusing on net zero and ESG. And after that, of course, from the end of March, we will kick off with our physical events. We have a very long event calendar for this year, starting with our annual event in Bratislava and covering all the markets in Central and Eastern Europe, and of course our flagship event in Vienna, the CE Property Forum, which will take place in November this year. Please make sure to subscribe to our newsletter and follow us on LinkedIn. Without further ado, I'd like to give the floor to Markus. Welcome.
Thank you, Csanád. I will start. Hopefully, I rehearsed it, so I hope sharing the screen will work going forward. So you just have to switch now. So you just have to. Sorry for that, but that's the
beauty of a live.
That's the beauty of showing how it should not work. But
right.
I'm pretty sure we will get it done in a second. So.
Exactly. In the meantime, I'll introduce Markus again for those of you who are...
And I finally got it.
We're just joining us. Markus Cieleback is the chief economist at Patrizia, which is one of the leading institutional investors in Europe. So, Markus, the floor is all yours.
Thank you. And also warm welcome from my side. I want to give you a little bit of an overview of where are we in the current environment, and possibly also what will be the impact for real estate over the year 24. When we had a short discussion before the meeting, the question was how negative I am. Possibly I'm skeptical, but not that negative, because I think a lot of what we have on the horizon, the challenges we are facing are, yes, they are new in a certain sense, but they are possibly in some cases not that new as some people might think of. Looking at
Markus, sorry, just one second. You still haven't shared your slides.
Oh, sorry for that. So I'll have to. So which screen you are now possibly seeing? I'll have to figure that out. So you're now seeing the screen?
Yes, all perfect. Thank you.
Thank you. Sorry for that. You know, technically, I'm working on it. I mean, this is possibly the most, let's say, influential slide, or the slide that explains the most of the challenges most of the real estate sector has been facing over the last, let's say, 12, 18 months. And it is, as I will explain to you in a second, it is the dynamic of that interest rate rise that is really the huge challenge when it comes to what's happening on the real estate markets in general. I mean, And what I try to highlight on the following slide is a little bit, we looked at interest rates, the interest rate structure over the, let's say, last 4 or 5 years, always at year end. And you see end of 2020, end of 2021, the red and the gray lines. There was a close proximity of where interest rates have been. But then you see the jump into the end of 2022 or the December 2023, which is quite close to what it was at the end of 2022. So it is this unpredictable or unexpected jump, actually, that is challenging most of the real estate markets in the current environment. And as you see in a couple of minutes, it is that jump and not the level per se that is actually challenging the real estate markets. And why did this jump happen? On the one side, it definitely was the result of Russia's invasion of the Ukraine. But that Russia invasion of the Ukraine was maybe the one reason for what you see here, the dramatic increase in inflation. It was not solely the reason for the increase in inflation, but it definitely was the increase for the rise of energy prices and the resulting effects on inflation. But the positive sign you can take away from that slide is we are actually, by the end of 23 now, coming closer to the central bank targets of plus minus 2% of inflation as a goal. So these strongly inflationary effect we had over especially 2022 of energy prices has now become to a certain extent deflationary. So there is now a strong support that we are approaching again the inflation targets, and that is the positive result when you then look at what are we expecting going forward on central bank rates. Yes, we had this dramatic increase over 2022 and the first half of 23. We have now reached a plateau, I would say. And going forward in the second half of this year, we definitely can expect that we will see interest rates declining again. There is a huge talk now in the industry, when will we see the first signs of interest rates declining again? And I think the ECB is possibly in a challenging environment as it tries to protect its reputation. And due to that, I would think that it is possibly reacting later than earlier, just to make sure that there is not really a move too early to let inflation resurface again. Because as I've shown you, there are deflationary tendencies in a lot of areas of the consumer price index calculation. But there are also other areas where you can still argue that there might be price pressures emerging again. But with all these kind of forecasts, keep one thing in mind, and being an economist, I can truly tell you, our forecasts have been not the most precise in the past. You see in the actual deposit rate of the ECB, you see here as the bold red line, and the dotted lines are always the forecast that the survey of professional forecasters resulted in when the ECB questioned the forecasters. And what you see is that let's say the predictability has been to a certain extent limited. Therefore, although I've shown you these kind of declining pattern here, take it with a pinch of salt and be aware of the fact that there are risks still remaining outside that might delay that interest rate response of the ECB. But on the other hand, you should keep one additional thing in mind, and this is what I try to visualize a little bit with these longer term perspectives I'm giving on that slide here. Yes, interest rates have declined significantly over the last 18 months. But if you go back to the noughties or the 1990s, we still have a low interest rate environment. We try to forget after these zero interest rate period we had before the outbreak of the war in Ukraine, that actually slightly higher rates are still historically a low rate environment. So the real estate market is challenged by the dynamic of interest rates, but it should not challenge be that much by the level, because it's still a low rate environment to a certain extent. The bigger challenge real estate markets possibly have is coming from a global portfolio perspective. And what you see here is on the x-axis, you see global total returns of bonds. And on the y-axis, you see global total returns for stocks. And what you see is that 2022 was a miserable year for both sides. And that was actually the year where every institutional investor increased its real estate quota due to the passive denominator effect as stocks and bonds were devalued. So last year, 2023, you see some improvement on the global equity side. Global equity return, total returns around 20+%. But if you look at where global bond returns have been, it's slightly above 5%. So the denominator effect is less important as it has been at the beginning of last year. But it's still a challenge for many institutional investors. Therefore, we should not expect a very fast return of the huge liquidity we have seen before interest rates start rising in 2022. There are still a lot of investors that are, I wouldn't say over-allocated, but they definitely have high allocation to real estate due to denominator effects over 2022 and to a lesser extent of 2023. And we have to admit that real estate as a lagging sector is possibly only catching up to some of the valuation changes we will be seeing in the market or we have seen on the stock and bond markets in 2022. So looking at valuations, I think the interesting question is, where are we from a valuation point of view? And what I want to highlight to you here is the blue line with the red crosses are the adjustments we have seen after the global financial crisis. Although the two crises are definitely not similar in cause and consequences, it's the last major crisis we have seen in the real estate market. So it's here just for a comparison to also show you that although real estate might be a lagging sector compared to stocks and bonds, a lot of the valuation adjustments have already been taking place over 2022. So the positive takeaway of this is, yes, real estate might be lagging and some valuations might still be adjusted over 2024. We definitely have seen a lot of adjustments already taking place in 23. So the valuation effect will be less dramatic in 24 compared to what we have seen already, or what we have seen historically. So we shouldn't be that afraid of the adjustments we should expect going forward. And how does all this sum up? And I think it's not a big surprise that it sums up in a, let's say, declining investment volume across all sectors and regions. And if you dig deeper and let's say have a closer look at Europe, which I think is more appropriate for the webinar we're looking here today, yes, we are at the transaction level in 23, which we had last time seen 10 years ago. But we also have to acknowledge that especially the years before rising interest rates, meaning 21, 20, 2019, have been unusual. And I think even 2022 was still unusual on the level side, given that it had a backdrop of a near zero rate environment. And if you look at 2022 in more detail, you'll see it is the first quarter and to some extent the second quarter that was holding up the volumes. And in Q3 and Q4, you are more closer to the levels you've seen in 2023. So overall, the recovery will take place this year. But we shouldn't be surprised. We should not be surprised if levels of the years 21, 20, 2019 will not be reached this year. We might see a slightly higher volume than 23, definitely. But it is an environment where we still see adjustment taking place, where we still see investors that have a relative high allocation to real estate and are cautious investing anew into real estate because they fear that, given the effect of the lagging sector, that they have to wait until valuations are more closer to where they have been or where they think they should be. And the big challenge here is that this zero interest rate environment has, I would say, biased our overall assessment of real estate. Because if we agree that this zero interest rate policy was unusual and unnatural, then any bond yield gap we can calculate based on this period should not translate in the future. And we have to learn what the true bond yield gap in the future should look like. And this is the process of transition we currently see in the market. So what are the themes that will drive the real estate market going forward? I think one of the areas definitely is decarbonization and energy transition. That has a huge impact on what's going on the real estate markets. We all know that net zero is a challenge. And maybe we have to admit that net zero in some sectors is not that easily possible as we would like it to happen. But it is a major driver that will be a theme that will resonate across the real estate sector going forward. We have demographic change and urbanization. Yes, we have seen during the pandemic that some households migrated to suburban, more greener areas. But at the end, if you look at long-run trends, cities have emerged because they are places of opportunities, places of exchange, and places of innovation. And that will not change going forward. Innovation will not take place at the kitchen table to a large extent. It's collaboration of people. And that will take place in cities. So we will have urbanization and demographic change as drivers as a theme driving the real estate markets going forward. Digitalization is the huge opportunity that is offered in understanding our buildings better, in understanding data flow, in knowledge flow between buildings and managers. And this is one of the big areas where investments will also facilitate some of the challenges we have for decarbonization and energy transition. And on the other hand, we have climate change. The sector will have to adapt. We'll have to learn that the last 20, 25 years are only to a certain extent a good guide of what is a good building, what is a good location, and understanding what will be a good location in the future. Overall, what are the implications for this? From a city point of view, affordable living is the huge challenge we see all across Europe, we see all across the globe. We'll have to find ideas of how we can deal with these affordable living challenge. Decarbonization, energy transition, I already alluded to. It is the huge responsibility of the sector to really engage in these areas and find solutions and how we can contribute to it. We have to understand how alternative asset classes, might it be student housing, data centers, or whatever or life science, how they can be, let's say, first of all, constructed and built, and how do they fit into the overall challenge of decarbonization? Because if you look at data centers, they are hugely energy intensive, and we have to understand how do they fit into the overall picture. We need them to enable the digitalization of the whole sector. But at the same time, they are the challenge in how to get decarbonization right. And on the other hand, real estate debt might be also one of the big stories going forward, as there is an increasingly challenge on what can be financed, what banks are willing to finance, as real estate is still seen as, to a certain extent, a high-risk sector. And with all these opportunities, we shouldn't forget that real estate, for many institutional investors, it's a core play. It's diversification, inflation protection, it's the stability of the income stream. So we have to defend this core initiative, this core element for investing going forward. Looking at our tenants, how stable is our income stream? We have to look at our offices, which are needed, which places are needed, and how does it have to look like? The portfolio of the future, what is happening with the alternative sectors? If you are a core investor, data centers is something you're not used to. How do you integrate it in a portfolio context? And ESG is already mentioned in all aspects I've talked about of decarbonization and the energy transition. So we really have to understand, on the other hand, how can we defend the core element of real estate investing and bring it back to the investors, as this is one of the crucial stories going forward. And with this, maybe a little bit of an ironic view on the future, being an economist, that possibly sums up my view on how I see it. So you can now think of, are you an illusion and have a question, or if I'm not completely mistaken, you are possibly real and have some questions. So Csanád can bring up some questions and we can start the discussion in a few seconds.
Thank you, Marcus. Yes, I do. As I said in the beginning, I do encourage everyone in the audience to please come up with some questions. In the meantime, I do have some on my own. As always, one thing is that you mentioned that, you know, urbanization, and I think we had the pleasure of having you last year at some of our physical events as well, and as far as I can remember, this topic was one of the major points also last year. So urbanization is there. It's still a strong drive. But my question is, does it affect all asset classes the same way? I mean, obviously, and you mentioned resi is a winner in this, as we have housing scarcity basically in all big cities across Europe. But how about other asset classes in real estate sector, like office, retail, and so on?
I think urbanization is a driver for changes in all sectors. It is a driver for changes in logistics. We talk about urban last mile logistics simply because the change in retail and buying behavior demands 24-hour delivery, sometimes same-day delivery. So it's impacting logistics locations and where logistics operators want to locate to fulfill the requirements of their customers. It has an impact on offices, because we all know what is the future of the office is to a certain extent still unknown, but I believe that there is a future for the office. It might not be the typical 5 days, 6, 7 hours in the office, but first research already shows that innovative capacity of teams, meaning groups of people in this time and not the online conferencing system. So the group of people is more productive if it's sitting around the table, because you get these informal feelings, what people react to, that you get in a different way when you're sitting in a conference, when you're sitting in an online conference. So offices will be there to stay, but they have to be more dynamic, more adaptable, and they have to be attractive for the young talent to come in. So it will impact locations, it will impact building qualities, and therefore urbanization will shape where the future office hubs will be and where and how they will look like. And that inevitably has an impact on retail, because if people come in or commute in and out to office locations, there will be retail sectors that are positively impacted, and there are places that are negatively impacted. Also, the change in mobility patterns. I mean, if you have a business park that is solidly reliant on car buyers, it will have a challenge going forward if people change their mobility pattern to bikes and maybe public transport. So you have to think about how can you make these these shopping places more accessible for the changed mobility patterns. And overall, this means all sectors will be impacted by urbanization to a different degree. But that is also some of the areas when we talk about developing quarters and not developing an office building. It's developing an area, thinking in mixed use terms. How can we integrate different use types? And if you start thinking that way, you immediately realize we possibly have to get away of the silos of thinking in office, retail, logistics, and residential, and more in a way of how can we develop a certain area and what type of usages are suitable for such a location.
Overall, mixed use is on the rise, right?
It definitely will come if we want to change mobility patterns. And if we think of a 15-minute city, you cannot say this is an office district and you're living half an hour outside, because you cannot reach the office in 15 minutes. So we have to think of an integrative approach. If we want to reduce CO2 due to commuting, we have to find ways of getting living and working more interconnected. It will not work for all all job types, but at least for some, we should try. Otherwise, we will be challenged by the adaptability of the city to climate change.
And you mentioned 15 minutes cities. Do you think this concept will be a strong driver in Europe?
In some places, I would say yes. If you look at cities like Paris, where they have the idea of the 15-minute cities in a very prominent form. But also, we have to be honest. I mean, you cannot implement it overnight. It's a long-term plan that cities need to have and that cities need to commit to. And it is something a city cannot do on its own. It has to look at its whole metropolitan area. And there where political challenges come in, because it means that different type of regional communal governments have to work in a coherent way on a common strategy. And whenever you have different political bodies that have to work coherently on a combined strategy, it's getting complicated. And I think this 15-minute city is one of these examples where the challenge does not end at the city border. And this is something where a lot of regional governments will have to learn and to adapt. It will get more important, but it's not the solution for the challenges over the next 5-8 years. It will be a longer term solution.
Right. Finally, about interest rates, you talked about it quite in detail about how the predictability is in question. What's your personal forecast when it comes to ECB interest rates this year?
I think you will see 2 or 3 moves in the second half of the year downwards, because I think there is, at the end, there's a lot of talk about wage pressures bringing up inflation again. But I think we have to be honest, after 2 years of negative real wage growth, we possibly need some positive real wage growth going forward. So wage increases will happen this year, and they need to happen if we want to see some consumer spending continuously ongoing. So nevertheless, the ECB is very cautious due to its reputational challenges it has. This is why I think it will possibly move later, as a pure economic argument would suggest, meaning Q3, Q4, where we see the moves. And I don't expect one in Q1, definitely. And even Q2, I think, is a challenging environment for the ECB to move. So look at the second half, and then you're possibly on the safe side.
Right. All right, Marcus, thanks a lot for joining us again. It was a pleasure having you with us, and hope to see you in person as well in the coming month.
I hope as well.
All right, thank you, Marcus. And as I said, we'll go on with our panel discussion. So I'd like to ask all of our panelists to please join me here in the live webinar. As I said, this is our first webinar this year, focusing on the investment market of Europe and more in detail Central Eastern Europe, as this is really the scope of our panel discussion. this is a part of our series of webinars. Next week, a week from now, we will have a webinar focusing on ESG and net zero. And again, as I said, from late March, we will of course start with our physical events as usual. So I'd like to welcome all of our panelists here today. We have with us today Waldemar from Victoria Dom, Karol from Futureal, Marius from IULIUS company, Hubert from Aareal Bank, and Adrian from Skanska. I'm pretty sure that most of our audience is familiar with the gentlemen with me, and of course the companies they represent. But again, just a quick intro. Adrian is here representing Skanska. He's head of Divestments Central Eastern Europe. Skanska is a leading office developer in Europe and in Central Europe. Aareal Bank is a leading real estate financing bank, and Hubert is general manager for CE. IULIUS company, represented by Marius as chief operating officer. IULIUS is one of the leading developers and asset owners in Romania. Futureal is a leading CE developer. Here represented by Karol, and Waldemar as VP and CFO of Victoria Dom, one of the largest resi developers in Poland. Just jumping into the in the middle, we've been listening to Markus Cieleback's presentation on inflation, interest rates, urbanization, and how different asset classes are likely to be affected by all the changes and challenges that we're looking into the year 2024. Basically, my first question is, what's your number one concern for this year? Hubert.
Yeah, hi, hello everyone. So Chris, thank you very much for the introduction. It was really well done, and also I did like this presentation before. I had a chance to look at the macro comments to the market. Well, from our perspective, the biggest concern, as it was also last year, and it seems it will be also moving forward this year, is lack of larger transactions on the market. Since we as a bank, we are open for financing. However, historically, we always looked at bigger transactions, either bigger assets or portfolios, usually with more core capital, more core than opportunistic. And last year, we clearly saw that there's lack of such investors and all transactions on the market. And we hope that this year maybe will slightly improve, as it was also commented a bit a few minutes ago. But well, so at least what we hear and what we expect, we shouldn't count on strong improvement in this respect. So from our perspective and our strategy perspective, this is the main concern. Of course, this is connected with the interest rates and overall sentiment towards real estate. But if you ask about a major topic, I would mention this one.
Right. Adrian, what's your take on this?
I think there is a movement of capital already, but of course in cities like London and Paris. So you can see London being right now, even when I speak to some of colleagues from Central Europe, some of the investors, they are also like flying over to London to look at some opportunities. So it seems like like a kind of a turning point, at least in London. So you have this variety of capital chasing right now London. Of course, having Asian capital being one of the top payers for any London property. So that would be my take, that there is some turning point. Of course, because of the fact that the yields contracted so much, or like the prices contracted, or the yields increased in London. So there's an opportunity. But as you know, this market's reverse quite quickly. Yeah? So then, you know, we definitely will see this capital moving to other locations. And from our Central European theater, I believe you know, the best position right now has Warsaw, you know, especially CBD Warsaw. And you know, talking about transactions, yes, you know, I think I had some statistics from Johnson & Lasalle that the average transaction in Europe was like 35-40 million euros. So these are small transactions compared to previous years on average, of course. So this will be the same, let's say, pattern happening in Warsaw and other capital cities in Central Europe. However, at least, you know, there are some rumors that you know, some of the office buildings which are called towers in CBD of Warsaw are being right now discussed. Yeah, so then we are talking not, you know, 30, 50, 60, but rather 300. So it's interesting because I think from leasing point of view, because all of the developments are so constrained from the fact of lack of debt available for development, and second, of course, the fact that you know, it's hard to you know, match or basically build a project sometimes at the levels of the rents which are right now on the markets, especially, you know, in some secondary cities of Poland. So then you will see, because of these constrained developments, quite, I mean, I'm very positive, very bullish on office rents in prime office buildings. So it will be a bit of a different, in my opinion, different game. You will see some of the capital moving in to office buildings where you can still see some under rented situations. So if you can secure an office building in CBD of Warsaw at the level of, let's say, you know, 20, 22 euros, you know, prime, you definitely have a, you know, a huge opportunity to earn on the growth of the capital value from the fact of growing rental rates. I'm not, like, of course, you know, thinking about decreasing yields, but more of a you know, this the fact of the denominator growing up in this equation. So that's my take. I don't want to take, you know, too much time.
Sure, thanks. Marius, what's different this year compared to the beginning of last year? What are your initial feelings for the year ahead of us?
Hi, Csanád. Hello, everyone. Good to see you in this format. I don't know if something is different. We always are. We are always, as humans, we are searching new stuff, different stuff. We always think that very spectacular things are ahead of us always, which seldom does, because usually it just keeps going on like it was, and there is a certain constant, and well, some variables always appear, but maybe not that spectacular as we wish or we think they will be. So continuing on that line of thought, I think that for sure we need to see this year how the consumer behavior will be influenced by everything what happened, at least over the last 3 years, meaning pandemic, inflation, wars, so on and so forth. And last but not least, also the tax pressure, which is becoming higher and higher everywhere. And of course, he is not an exception. So for us, yes, this will be a big question in 2024, to see the purchase power, how is influenced by all these factors, because at the end of the day, in the economical circle, there will be an influence on each and every class of assets. You cannot have lower demand, but in the same time, the same demand for logistic, for retail, for office. Unemployment rate is another thing that we will watch very carefully through 2024, because I think that the high levels of employment, at least over the last decade or two, has a lot of influence in the way that people see and treat work. And here I put in brackets the work from home factor. And last but not least, coming to the, let's say, with the view on the investment market, I think that maybe we are more polarized than ever before between buyers and sellers and pricing expectations, because on one hand, the developers like us, we know very well what it means to develop these days something. And then the buyers, on the other hand, they are looking just at the macroeconomic fundamentals, but I don't think that they put very much price into the real effort and costs these days. So therefore, yeah, we witness what I think Hubert said at the beginning. There are just a few transactions on the market, and there is an explanation why. Because everyone, I think that needs to be more realistic. Thanks.
To sort of navigate on, let's say, to the opportunities, or the rather the you know, the more positive aspects of this year. Waldemar, what's your number one, let's say, positive factor that you see on the market right now?
Well, I believe over the last 2-3 years, we've been witnessing a lot of volatility and unpredictability that everybody is facing every single day or every single month. Changes legislation, change on focus on ESG, a lot of delays in administrative procedures. This is what we are basically dealing with on every day. But I believe there is a lot of opportunities, especially in the living sector, broadly living sector, whether this is pure residential or any other forms like student housing and senior housing. There is this growth of urbanization that Marcus was mentioning over the last decades, and I think this is what will also follow. So I believe the positive thing that today there is Central Eastern Europe, and especially this is where we operate, Poland seems to be like one of the top locations to come and do business in residential real estate. As difficult as it is, yeah, there are possibilities in the near future of lowering interest rates. We also see a lot of still inflation that is delivering growing cost structure, but also growing revenue structure due to the possibilities to pass some of those things, pass some of these costs to the customers. So I believe in general, Resi seems like still a very good place to be. I believe this is also what Marcus was mentioning, that affordable living is becoming a challenge. And when you focus on low costs and low selling prices, this is where we basically lead in how to make the house more affordable to those who live or those to buy. This is a challenge, at the same time a big element that you should focus and try to find a lot of opportunities to redesign the way people live, to redesign the apartments in a way that they would be more functional rather than space oriented, which creates a lot of costs. So I believe the future is still bright. Every now and then, every single government in every single major city in Europe is trying to find solution how to make affordable living, how to make people being less burdened by the growing rental prices or growing prices. And we, a developer, we see a lot of solutions, but none of these solutions are being implemented by the politicians because they're not popular. But I believe the more we go, we'll see that there should be a more flexibility and more drivers that would allow this affordable living to come into focus. And this is what we basically count on.
Right. Karol, you're leading originally Hungary-based CE player, and you're obviously based in Warsaw. We already jumped into, you know, where and what, as Adrian said, it's CBD Warsaw, and Waldemar said it's Resi. So Futureal is traditionally doing Resi and office as well. What's your strategy for 2024 and moving forward when it comes to where and what?
Listen, we are a commercial residential developer, but we also investor. So from our perspective, for sure, like a residential and a logistic is something what we really believe in, and we are looking for new opportunities on the market. We're looking for a size, but also the existing assets. However, from our kind of investment perspective, we are also like a value-add opportunistic. We really like the projects which are probably not so shiny, which are being sold by the developers. We like to find something what we can bring the value. And these are exactly the projects which we'll be focusing on from the investment perspective this year. I agree with you that probably this what Adrian said about Warsaw and the Polish market. It's probably better from Central and Eastern European perspective for us because the liquidity is a bit higher than in the other countries in the CE region. But at the same time, we are looking actively for opportunities in Hungary and Romania in the region. However, it has to be really something what our investment committee really likes, meaning it has to have this value-add element. Whenever we are looking beyond Central and Eastern Europe, this is also something where we are trying to grow from our logistic perspective and residential. But focusing on Central and Eastern Europe, I think that the Poland for sure will be still, you know, something more interesting on our group level, because we have a quite high exposure into the Hungarian market. That's why we are trying also to somehow find the balance between the other markets in the region where we are operational.
Right. When we, you know, talk about asset classes and locations, I think one of the major question all the investors and developers are asking is what banks are willing to or like to finance. Hubert, what's the let's say the preferences for Aareal Bank for this year?
First of all, we continue financing, and we are hungry for new business. Of course, needs to be a reasonable business, but we definitely look for this year, looking for opportunities, and we would like to allocate a relatively large chunk of our loans into CE region. From the asset class perspective, logistics still continues to be very attractive for us, and I believe for other banks too. And this is across the region, and we continue for us, especially logistic portfolios, because they create a volume which is important for us. I would say that retail is slightly coming back to our attention. During the COVID, it was clear that for most of the banks, retail was, let's say, a bit more questionable asset class, and there were many discussions, you know, how it will go through the COVID period, and also then how it would recover. We noticed last year that actually last 2 years, but last year it was clearly visible that parameters improve for most of the retail assets. not only retail parks which survived very well let's say these tougher periods, but also shopping centers start to do a bit better. Footfalls are coming back to levels of pre-COVID times, sometimes even exceeding. Turnovers exceeded already because of the inflation as well, but the nominal numbers look stronger. So that's why we are more open to like this asset class comparing to previous years. On the contrary, it's with offices. We have been financing offices eagerly, and there were many transactions done in past years. Now we still are looking at office transactions potentially, but we are much more careful, and this needs to be something convincing to us, and where we really see there is an investors' appetite, because the sentiment among offices unfortunately fell down. My personal view is that it's not accused by any bigger issues here in Poland or CE, but rather as a trend coming from US and Western markets, where offices suffered quite a lot. When we look into portfolios we financing in, for example, Poland, performance of the buildings in terms of reletting or leasing new space is really strong. And this is I think also confirmed by the general statistics showing the vacancy, for example, in CBD Warsaw is dropping. So we have like strong performance operating aspects of the offices. However, due to the sentiment, perhaps a bit less attraction for investors and also for banks. When we speak about other asset classes, we are still open and looking for hotels. Aareal Bank is really strong in hotel financing across the globe. And also in the region, we are open for such financings. In terms of resi for rent or student housing, this is something which we could potentially consider, but to be honest, so far we didn't have any loans in the region. Of course, we did have in other parts of the world. This is to mention Western Europe, UK, or even distances like Australia, for example. But in C, so far we haven't done any transaction like that. But potentially we would consider this also here. So I think in a as a kind of short outlook, this would be it.
Right. I would say that one of the major trends of last year was that repricing in CE was much slower than, let's say, in the more mature markets in Europe. And Adrian, you just mentioned basically that, saying that London has become sort of competitive even compared to Central and Eastern European markets. Do you expect this sort of repricing to accelerate this year in CE?
Just recently there is a much more popular word being spoken, and it is bifurcation. So basically I believe, and this is also a bit what Hubert was saying, that the market will just move into the assets, yes, will move into different directions in terms of popularity and attractiveness. So you will see growing demand for, and again, yes, you can say it's Skanska, and Adrian is giving a pitch, to sell his buildings, Karol, yes. But I want to also, do something, to your favor, that I believe there will be much more opportunities for companies like Futureal on the market coming from this, secondary locations, C-class, B-class of office buildings, where simply people are not, willing so much to come over and basically use office space. At the same time, there is no demand from any investors to buy such cash flow, yes? So it will be a great opportunity. And unfortunately, I believe, when you're asking me, Csanád, what will happen this year, I believe there'll be a further hit on this, secondary assets, yes, which are underperforming, secondary office class assets. Yes, but then when it comes to this prime office space, which has all this ESG efficiency and compliance towards taxonomy, so I believe there will be, like, not so much of a product and huge demand for that. Yes, so of course, yes, the markets which we are basically right now representing, they don't have so much liquidity like London. Yes, but at the same time, you have because of the fact that yields are higher in Central Europe, you have this positive leverage. Yes, so your yield versus the financing cost, which Hubert can propose, is always giving you some good cushion. Yes, so that's why there is a movement of capital towards Central Europe, and I cannot see further repricing on prime office assets. Yeah, so I would rather say that 2024 will be this turning point for A-class prime office space. Again, first limited to Warsaw, CBD, Prague, and definitely Budapest as well. Because of the fact that you have a strong local capital and quite, again, attractive office market. So that's this Csanád bifurcation which I wanted to describe, that the market will go sideways on this different types of office class assets.
So in other words, you predict a sort of widening gap between, let's say, less and more desirable products, right? And I assume that ESG compliance is sort of facilitating this trend.
It's one of the factors, but another factor is definitely this work from home. So if you want to attract, we have this example of an office building in Warsaw, in Mokotów. Yes, it's like the Mokotów has the stigma of like the worst market in Central Europe for offices. At the same time, we have a building which is located on the subway station, and we have a movement of tenants coming from this let's say congested, without infrastructure region of Służewiec, yes, of Wołoska and Domaniewska, towards our location, because you have the access for people, easy access for them to get to the office. And then, of course, you have if you go and you see some of the tenants and their fit out, it's something really amazing. So this is attracting people to come back to the offices. So it's not only ESG, but it is also the work from home aspect, which makes this prime office space very attractive for tenants to come back to.
Right. Marius, any comments on the trends that Adrian just described?
Yes, I have a few comments, especially because we are active in the regional capitals, in the secondary cities in Romania, and it is a bit sometimes strange to hear all the complaints in the office sector, given that we fully developed and fully leased 2 office buildings during pandemic. So it proves that actually, well, with the class of assets, there is absolutely no problem. There is probably a problem with the quality of the product, which we agree. And I think that in time now, people will just realize that the development model used until recently, where we had just fewer CBDs, so conglomeration of office buildings of hundreds of tens of thousands of square meters for office, even millions in some cities, without any services around, is probably not anymore appealing to the market. And both tenants, and especially the employees working for office tenants, they need a bit more. So you need to somehow not only to change the carpets in the office building to make it attractive, but you need to ensure and to provide to your end clients a lot of services and reasons why they should come to the office. And we see it in the offices that we have. Across portfolio, we have 1% vacancy because our offices are integrated in mixed-use assets with retail, with administrative services, kindergarten, so on and so forth. So they are literally small cities built in the cities. And therefore, people can come up, let's say, 7 in the morning and leave 10 in the evening, having everything what they need in one spot. Office, kindergarten, shopping, leisure, cinema, restaurants, so on and so forth. So it is very interesting to see that actually these days, this type of concept really pays off with a lot of green spaces, especially because the new generations, the younger ones, they are very attracted and they put a lot of value in the environmental, on the environmental aspect of the place where they work. And we continue to have plans, development plans for further projects that will include, of course, like we always did in our projects, retail, office, and other services. And of course, the core being the green areas. For us, it is not much as of a change in terms of mentality and in terms of what we have on the draw board. It just encourages us to continue on the road we took more than a decade ago when we took the strategic decision to invest just in mixed-use projects with a very strong sustainable component. So retail, as also Hubert mentioned before, yes, it just runs magnificent, I would say. Over the last 2 years, we register record after record when it comes to the operations of our shopping centers, and we are at very good levels, pre-pandemic levels, exceeded even. Office, as I said, it runs also well because if it's the right location and the right concept, I'm sure that the success will come in each and every city within CE. And then what I think it's also important is just to think of the fundamentals of business and not to split it day one between countries or capitals or non-capitals. You just really need to understand the local logic and the regional logic of the areas and the development of those areas. And then you see also the opportunities.
Right. Waldemar, as a major resi developer, do you also see that multi assets and mixed use developments are also the way when it comes to resi?
Well, I believe what we do is we concentrate on affordable living locations, which basically trigger very limited amount of mixed use. So basically, it is a trend where you build in more central locations, and whether you want to create a 15-minute city, it's more about being located closer to the city centers rather than far away or in the outskirts of a city where we normally build. But yeah, basically pretty much every customer who buys, it's a place of his living, it's a place where he spends some time. So there has to be an adequate infrastructure that would support his living needs. And whether and how it would transform into a full-blown new strategy, It is a question basically location by location. On a location that are not off the city center, well, I don't think there is no room to basically make such developments, because you may have some issues with tenants. And we as a resi developer, we buy and sell. We buy, develop, and sell rather than keep those assets. So if you have a mixed use, it's more complicated to resell those assets to investors, unless you have financial investors that buy this entire project. But it's a different concept that we haven't done anything like it in the past year.
Right. What you know, in the case of affordable living, interest rate is definitely crucial. In the previous presentation, I asked Marcus, and he said that he expects 2-3 downward moves from the ECB this year. What's at Victoria Dome? What's your expectation when it comes to interest rates?
Well, my expectation is it's negative again in Poland, but it's never been in Poland. We've been in a relatively well, I wouldn't say high, but relatively elevated level of interest rates for the last 2 decades, and right now, where we come back to a 5% or 4% level, it's nothing spectacular. Of course, it's better when the customers can have 4% mortgage loan, which when we hear or we also do some business in Germany, when a German buyer thinks of 3.75% interest on his mortgage, he basically gets a heart attack. But where we talk about this level, everybody is just happy to have almost a mortgage loan for free. It's a different conceptual thing, and how we perceive investment in Central Eastern Europe, because it's pretty common in this part of the world where buyers normally, or those who are using the apartments, they tend to buy it rather than rent. And I think this is what is driving a lot of the acquisitions these days. There is a high level of savings in saving accounts in Poland. People treat this residential apartments as the good investment where we can use or resell or rent. So basically, this creates, of course, a good momentum when you have some extra support, the government support, which is not. Poland was last year was not the only country in Europe where the government decided to subsidize part of the interest, and we've seen it in a couple of different cities. But it created a completely new momentum into the residential industry from a extremely difficult 2022. Which became even worse in 2023 in Western Europe. Polish residential market basically boomed. It was the best year we've ever had in our history of our company. We sold more than 2,000 apartments, and we were not the only ones who benefiting. Basically, the entire market came back to life, which created a lot of jobs or basically maintained a lot of jobs in the industry. And where we see the slump in Germany, this is amazing how bad government may lead their residential needs for their population. So yes, I think this is a good place to be. This is even in a current interest rate level. It slowly will go down. I believe we estimate maybe 50 to maybe 1,000 basis points lower interest rate by the end of this year, which would basically will bring down the mortgage loans to something that has 5 in front of as a figure. So which basically is nothing unusual for Polish buyers and investors or individual investors we deal with in Poland. So I think we would see some normalization, and of course we'll see how it would translate into the bigger demand, because there are, as I mentioned before, there are a lot of cost drivers that basically makes the apartments even more expensive, and we see where supply will meet demand. Right now, I think demand is much higher than supply because of all of the administrative burdens and lack of development land in the major Polish cities, which basically is keeping the prices on the level that it makes sense to start and develop those plots. So yeah, I think we see some normalization of a monetary policy that would basically create a lot of good movement throughout Southern Eastern Europe.
Right. Hubert, what is the overall expectation for interest rates for this year at Aareal?
Yeah, well, we don't have any own prediction. We are also based on other macroeconomic analysis. But first of all, when we look at financing costs, usually transactions are financed for a longer period than 1 year. Usually it's 5-7 years in real estate, and this cost, when we talk about interest rates, already fell down, because last year I think the peak was around 350 for a 5-year swap. It went down in January this year to more or less 250. Currently is slightly above. But this shows, that the market already envisage interest rate decreases in the future, because Euribor is around 4%, it's 390 more or less. So the short-term rate is already way higher than long-term one, while all the participants, perhaps except of short-term developments, are using this longer rates for financing. So I would say that there's already some ease from this perspective, and well, whether this will encourage transactions, hopefully, but I don't see that it's this drop is so significant to really boost transactions too much. So definitely it eases calculations on the buyer and seller sides, but still I would say that may not be sufficient to boost transactions only from this perspective, from interest rate one. And what's more, hopefully this year, it's not our base scenario, but this is a bit more that we hope for, is that in the second part of the year there will be some transactions visible, and there will be market moving a bit further. I mean, I'm talking about CE, because someone mentioned this already. In UK or Western Europe even, it is already visible. The transactions are happening, of course, lower levels than before, different pricing, but there are transactions. So we also hope to see it in CE.
Right. My next question is to Adrian and Karol. Adrian, you mentioned that there are rumors of those major towers being in discussions. Let's suppose one of these transactions will happen. What's the what's the guess for the investment yield for these products?
Yes, it's hard to say, Csanád, yes, what kind of yield it will be. But definitely, the fact that there is interest, yes, in such product, yes, that there are discussions, not only coming from, let's say, because what is right now being, let's say, played by this major capital holders is of course debt, yes. So everyone is chasing debt, and you talk to Oaktree, you talk to BlackRock, all of those guys, they'll say our strategy is that. So definitely, there are market players who are coming and using the situation to basically capitalize developers, asset owners, yes, in some other form, yes. So this has been happening so far, but if there is equity movement, towards these bigger asset classes. And again, I don't know where the yields will be in CBD of Warsaw, because there are no transactions yet. But the market always moves, it's a kind of a crowd psychological adventure. Yes, that if someone moves first, then the rest follows. So if you see one or two transactions, then I expect if something happens positive in Warsaw in this regard, it can be a bit of a you know, like a, you know, really like a competition for some of these assets that you can still buy, let's call it cheap, compared to previous years. So the situation can, you know, really dramatically change because of the perception, yes, that if someone says like, okay, maybe this is a turning point, so then, you know, the competition will move towards places like, again, I was talking about CBD Warsaw, which you have to look very carefully on the map where the, you know, rental rates are going to, you know, increase, because then you will be able to apply, let's say, okay, Warsaw yield, you know, Warsaw core prime yield is, I don't know, 5.75 today, yes. So if you have under rented properties, maybe you can pay a bit more in terms of the yield, yes, because you will extract that into the, you know, from the market rents around you, while the transactions on this, you know, which have been happening 2-3 years ago, were at much lower levels compared to these days, yes. And there is this dynamic which simply shows that there is no supply on the market, and demand for office space in the CBD of Warsaw is not so much constrained.
Right. Karol, any expectations regarding how yields will develop this year, especially when it comes to Warsaw?
Listen, liquidity is coming back for sure, because we observe that we have one asset actually for sale right now. So we observe that there is an interest for sure, and people are asking much more than the last year. I wouldn't be so dramatic about the interest rates, because, you know, I remember 20 years ago when I started this business, the interest rates were at the level of 5.25, and people were not crying and they were doing business. So I think that the only thing what you have to do is just to amend your business plan and, you know, try to be more kind of a creative in terms of what you would like to achieve. I'm really quite interested about the rumors about the yields on the office market in Warsaw, because I heard that some kind of a Nordic developer is trying to sell 2 buildings in the one package to the investor from Singapore, and there are advanced discussions. So that would be interesting to understand what really the yields are being discussed. But let's probably wait for the closing at this case. I think that, you know, the yields is not really the problem. I think that, you know, it's more about kind of a long-term plan, what to do with those assets, and what are the investors who are coming into the Central Eastern Europe, and what kind of pricing they can pay for it. Because I don't really see the kind of a strong interest in offices, and, you know, it's being not only created by the tenants, but also the amount of capex which has to be invested into those assets after 5 years, when the tenants on average are leaving the office spaces. So this is just amazing. Like, you know, 5 years ago it was to put the proper capex into the building like 300-400 euros per square meter. Right now we hear, you know, from our peers that it's around 800, even 1,000. And last year it was actually even 1,200 in Hungary. So these are the huge numbers. So I think that for sure something like this will have a tremendous impact on the yields and kind of investment process. And I think that, you know, what we hear also about the retail, you also need to have a kind of a strategy. If you buy it, it's not only about, you know, to cash out from the tenants, from the cash flow. You also need to think, you know, how to rearrange the space, how to be more kind of active with your tenants, because we believe that not all of the shopping centers will survive this very difficult moment. And I know that everyone is excited about, you know, the turnover increasing, but because of the operations of the shopping centers over the last 2 years went up almost like 50%, which has a tremendous impact on the overall cash flow. So yields is the one thing, but there are a number of elements which are defining, you know, the investment strategy, which I would really still, you know, think about it whenever we are looking at the opportunities from our perspective.
Right. We got a couple of questions from the audience, and one particularly to you, Karol, asking whether Futureal/Cordia will be expanding into the UK further after your ventures in Birmingham.
Listen, we invested into the affordable housing into platforms. We also invested in Birmingham into the like a pipeline of PRSs. We invested into the office building in the UK, and right now we are thinking about actually doing something more. We have a pending discussions with the few partners because we are not willing to do it on our own. We are always trying, to enter the new market with the local specialists. And yes, I can confirm that we are looking at opportunities, but nothing tangible what I could discuss at the moment.
Right. A few other questions from the audience as we're heading to the end of our panel. One is from Plum saying, citing a news from I think last week when JP Morgan and BlackRock and and a few others have announced that they're quitting a climate change group for in Wall Street, and he's asking the comments of this. I suppose the question is whether this could be sort of a sign of, let's say, ESG not necessarily being as important in 2024 as it seemed earlier. I'm just trying to formulate the question here. Anyone?
So maybe I will comment on from the banking perspective, especially in respect to Europe, because I'm not commenting on other markets. But in Europe, I would say that ESG is getting more important than before. Of course, we are talking about ESG and taking this into consideration for transactions already for some time, especially developers, investors always looked at this, banks too. However, on the banking side, it was always, so far at least, more like something nice to have, not a must. But currently there are, first of all, legislation ongoing, but also ECB, European Central Bank, is involved as a body which will be pushing through this ESG, especially green solutions through the banks in Europe when we talk about financings. And the ECB will be putting new requirements on banks in this respect. So from banking, at least perspective, this will be more important, and sooner or later, I trust every single transaction will need either to be fulfilling this ESG requirements, or at least there would need to be a plan when at acquisition of how to achieve certain levels of emissions and requirements. And to be fair, these levels are still under discussion, so it's not so clear as we discuss it now. But in the coming months, for sure, there will be more clarification.
Right.
Yeah, I can only join Hubert in this. We are not using any debt on our properties, but we have investors, who are interested to buy our product, and I can see a very, very demanding side of banks asking for this taxonomy information, ESG information. So I have heard that it's not so much, let's say it's not so demanded from, for example, logistic assets, but from offices, there's a huge scrutiny coming from this point of view. So yes, I can only tell you from my experience. Sometimes, we are really surprised by the level of let's say, very detailed questionnaire on this aspects. Yes, and just to comment, not to leave this negative only view on these offices, because in my opinion on these factors like fit out, I believe that our offices, when you have some leases which expire, this never goes, this amount of fit out per square meter never goes above like 300-400 euros. Yes. So again, it depends what kind of quality assets you hold.
Right. Another question from the audience is about that 2024 is an election year, most importantly in the US, but also there are EU parliamentary elections and also in CEE, local governments. Local authorities and mayors are being elected in Budapest, in Bucharest, for instance. does anyone of you expect any major implications coming from the potential outcome of these of all of these or any of these elections? No one's. That's the first time you all heard about elections, right? It's always the most uncomfortable topic. All right. Let me check. Basically, that was all the questions from the audience. I just have one closing round for all of you, sort of let's say a simplifying journalistic kind of closing. My question is whether you expect, let's say, a more positive or a more negative year for 2024 than last year. Marius, as a start.
Yes, Csanád, probably I will finish like I also began, so to have a perfect circle. As I said, I don't think that in 2024 we will witness any spectacular changes. I think that the post-pandemic recovery will just follow. Of course, there will be some turbulences coming, especially from this new economical environment, more or less post-globalization, that has impact on everyone. Inflation, higher interest rates, work from home, the way we see life, the way we consider or we look at different regions as playground, which was not mentioned, but I think it's very important, because over the last 3 years, I believe that CE became and will become more and more playground for a lot of players in the Western real estate market, just because the fundamentals in this region are becoming more and more stronger, and it's evident for everyone that yields are still high compared to Western Europe. On the other hand, unemployment rates, they continue to be low. We see a lot of room, a lot of space for future investments in the region. And it's not just in infrastructure on the administrative side, but a lot also on the private side. Just putting head to head the, let's say, main ratios and numbers of Central Eastern Europe and Western Europe, we see that it is a place where you can do a lot, you can invest a lot. So I think we should be cautious positive. It will be not easy, but definitely a lot of opportunities will come also during 2024.
All right. Waldemar?
Well, I believe 2024 would be another difficult year, and with a lot of opportunities. We see that improvement of affordability and increase in wages of people in this part of the world will allow them to get more mortgage and buy more expensive apartments that we believe will come in the next quarters and years. I think there is a trend that is very positive for residential developers, and especially when you concentrate on large municipalities. And I think for Poland, it's where we operate. It's very interesting. On our German side, I believe it's going to be as tough as 2023 and the second part of 2022. So yeah, I think some challenges, some opportunities, and some day-to-day issue that you have to recover.
Hubert?
Well, what I can say, Marius and Waldemar said really a lot about the expectations, and actually they covered all the topics. What I can say from a financial or financing perspective, last year was very good for us, and despite that there were lower number of transactions on the market, we managed to do a number of big transactions, usually refinancings or of bonds or other banks, and so it was a very successful year. This year, we hope for good, but we know that it will be also a bit challenging for sure for the market and for lenders. Also, you know, that there's still some uncertainty in the area in respect to all these geopolitical and other aspects. So while we hope that slowly the markets and the business would be improving, we are careful and we're closely watching the situation everywhere.
Right. Karol?
I would say that we expect to be more positive this year in terms of the market. And probably looking at the time, that would be probably all what I should say at the moment, knowing what my colleagues said before.
Right. Adrian, a closing remark?
Yes, as my colleague said, so I can only add that I would look into the macro. So because in my opinion, as I said before, it will be more about increase of the rental rates, and of course, increase of the rental rates is the demand for office space, and demand of office space is coming from the economy. So we have to look at the countries which are growing the most, and definitely, you know, Romania is quite of the, you know, has some outstanding performance in terms of the GDP, but Poland is not you know, that much behind. So I will look into that. I will look into the map of, you know, where the office rates will be going up, and I will see this as a new positive trend, changing the liquidity on the market, because the yields will not move that much, but definitely the rents will move.
All right. Thanks to all of you for joining us, and thank you for the audience for the attention. And please do sign up for our newsletter or follow us on Twitter or LinkedIn, and hope to see you at our physical events as well, or next week at our ESG Net Zero webinar.